Hello, I'm Keith Black with RIA Channel. I'm joined today by Jeff Feinstein, Managing Partner for Pinnacle Partners, and Mollie Fadule, Chief Financial and Investment Officer for JPI. Welcome.
Thank you.
Thank you for having us.
So Jeff, tell us a bit about yourself and Pinnacle Partners.
Thank you, Keith. So I'll defer on myself, although I am the co-founder and managing partner of Pinnacle Partners. Pinnacle Partners is a registered investment advisory firm, 300 plus million AUM and growing quite fast. We've been an early mover in the execution of Opportunity Zone legislation, whereby we've capitalized close to $1.5 billion of affordable and workforce housing. And we've been anxious to embark on a purpose-built RA fund for workforce housing, which we're pleased to talk about today.
And Mollie, tell us about yourself and JPI.
Great, thanks. So I'm Mollie Fadule, CFO and CIO at JPI. We're a 35-year-old development and construction company dedicated to transforming building, enhancing communities, and improving lives. We've built over 118,000 multifamily homes in our history, representing about $30 billion of asset value.
Mollie, what is workforce housing and the demand drivers for those units?
So workforce housing really refers to both income restricted and affordable market rate rental units that are designed for the middle income earners in our country. It serves essential workers such as teachers, healthcare professionals, first responders, and service industry employees who are the fabric of the communities that we live and work in. Typically, these service employees do not qualify for low-income housing, but struggle to afford market rate or more luxury rental units. So it really caters to that household earning somewhere between 60 and 150% of area median income. And that depends on home affordability in each individual market, how those percentages are derived.
So Jeff, can you give us an overview of your workforce housing fund and how Pinnacle Partners and JPI have partnered to launch the new fund?
Yes, so we work very closely with JPI to look at their expansive pipeline of opportunity. What we wanted to do at Pinnacle is curate a fund of 4 workforce housing projects that were certainly identified, shovel ready, which we could begin to capitalize immediately and deliver at a time when supply is constrained considerably over the past year, and that we'd invest in targeted dynamic markets, which we can talk about in a moment. And then we, as we have done throughout the history of Pinnacle Partners, is we put the belt and suspenders around the fund to make it an RA purpose-built fund, meaning it's got custody partnerships, it has an audited fund, it's got all the necessary compliance support, so that an RIA can consider this as an attractive alternative asset. And our entire investment thesis beyond the product itself, that is the projects, is that the RIA community is desirous of more attractive alternative real assets. And so in working closely with Mollie, again, a very large pipeline of opportunity, we identified 4 projects that were shovel ready. In fact, one's under construction, and that we could capitalize in the very near term and would deliver an attractive rate of return to our RA clients, generally kind of a 16 IRR net, and is actionable. That is a lot of risk taken off the table, a lot of opportunity to enter the market at a time where there's still great need and demand for this type of product. And this, I should say, Keith, is a $200 million fund, which will capitalize the 4 identified projects.
So Mollie, tell us about those dynamic locations and what makes them attractive.
Sure, I'm happy to. So we do an extensive analysis of the top 50 MSAs in the US on a biannual basis, and we select high growth markets with strong economic fundamentals, high job growth, and particularly for the workforce projects, increasing affordability challenges. So the selected markets of the seed assets are Washington, California, and Texas, which all offer resilient demand for workforce housing, where job opportunities have been incredibly strong, but home ownership just continues to get increasingly more difficult. So there's severe affordability challenges in all three of these markets, with supply shortages due to the cost of building new housing. All of the projects have some type of support, whether it be municipal support or a tax incentive, that have helped enhance the project feasibility. And they all encompass areas where we feel like there's a very strong demand from that middle income renter.
So how does this development make sense relative to where we are in the current real estate cycle?
Well, we think right now is a pretty attractive time to be investing in housing, despite record supply that came with the low interest rate environment in the, I guess, around COVID and post-COVID area. Multifamily absorption rates have still remained very strong. As interest rates went up, you saw a significant drop off in new starts and supply. So you're starting to see, as that supply is absorbed, undersupply in markets that can still offer great investment potential. So rent burdens in these areas continue to be a challenge. And while, as I mentioned, a lot of new supply did come on, it actually was absorbed faster than most economists had estimated, which means that as we look out to 26 and 27, in the years when our projects will be delivering, you're delivering into a much lower supply market. And then you've also seen wage growth recently outpace rent growth, which creates an opportunity for potential improved rents, even in the middle income sector. And we also think that, workforce housing generally provides an interesting and attractive way to be exposed to the multifamily investment market because of the strong and stable demand, the favorable market dynamics that I mentioned before, longer term resilience. A lot of these tenants are wanting to stay in units longer than what you would call luxury or market rate multifamily, which allows us to provide attractive risk adjusted returns.
What makes this fund unique?
Well, this fund is, as Jeff mentioned, seeded by assets that have already been identified. JPI has invested the balance sheet capital in the projects to get to the construction start of all projects. So we take all of the entitlement risk and the permitting risk off the table and invest in and either buy the land or have the land under contract up to its contribution to the fund. So investors are able to come in when a lot of the development risk has been taken off the table. Further, by identifying the assets in particular, investors are able to look at each of the individual investments, underwrite them at a very detailed level to understand our assumptions, and then for themselves take an opinion on what the risk-adjusted return may be. As Jeff mentioned, it's backed by two sponsors, JPI with a 35-year track record of building over 118,000 units, and Pinnacle's team with expertise in the investment area and the RIA relationships. Further, we think workforce housing, as I mentioned before, is a resilient and high demand asset class. It also offers investors the opportunity to have a social impact with capital that they're investing. And we think that we're geographically diversified into key markets that we think are attractive for this product type.
And to close this out, Jeff, how is this an attractive opportunity for RIAs?
I think, as Mollie just suggested, it's a curated fund with identified assets. You can diligence each and every project. We've got a data room full of market comps and associated diligence that any RIA can pursue. And then, as I mentioned, it has the belt and suspenders to give the comfort and the confidence that this is a fund that can be executed on. And it delivers an attractive rate of return. So we welcome any RIA participating in today's session to inquire and to learn more. I think it's the right asset class at the right time. We also strongly believe and have high conviction that development now is appropriate and will deliver at a time, as Mollie suggested, when absorption has and supply have better balanced. And we're really pleased to be working with JPI. It was not mentioned, but effectively what JPI has done is acquired land bank these four identified projects and it begun execution post pre-dev to the extent that one of the four projects rather, is under construction. So this is truly an actionable, identified fund that an RIA can diligence at the detail level, and again have confidence in allocating on behalf of their clients.
Thanks so much for sharing with us today.
Thank you, Keith.